Hi, good afternoon. Thank you for joining me today. Using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have a lot of time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 that are included in this service. Valueline does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, it is vital that we have a firm grasp in regard to the current economy and stock market. I assume most of you would agree, especially now, as we navigate trade wars, potentially lower interest rates in the near future, and other potentially disruptive events. The following content was written by Harvey Katz, Valueline's managing editor and chief economist. The Federal Reserve's interest rate policy is evolving. To wit, the bank spent 2018 raising borrowing costs in an effort to cool down an economy that was heating up on the strength of healthy job growth and lower taxes. The better business tone, in fact, led the Fed to suggest that further rate hikes would be forthcoming in 2019. More recently, though, growth has cooled and inflation has fallen below the Fed's 2% target. That 1-2 punch caused the bank to suggest that rate increases were no longer in the cards for this year. Then, after the Fed's June meeting, and following the release of additional mixed economic data, including figures on home building, the Fed, while signaling it now had no plans to reduce interest rates immediately, did suggest that lower borrowing costs were on the way. Indeed, we are not closing the book on an interest rate cut or two this year, especially if upcoming economic reports signal more pronounced softness at home and further slippage abroad, or if high-level talks involving the United States and China at the G20 summit do not lessen the trade tensions between the two giant economies. Such possible ill winds and assorted other concerns globally, such as the unresolved Brexit question and the latest standoff with Iran and its ramifications for oil prices, also could threaten our decade-long expansion. Thus, the case for gradual easing in interest rates is getting stronger. Our sense is that upcoming rate policy is not etched in stone and that more Fed surprises could be ahead in the coming 6 months or so than is typically the case in the era of increased lead bank transparency. Meantime, investors are continuing to show patience and sufficient optimism to drive stock prices up to near record highs. Hopes for progress with China on the trade front, indications that the European Central Bank will be more accommodative in the near term, and the fairly bright economic picture painted by the Fed are a positive combination for investors. In conclusion, Wall Street's bullishness appears justified, and investors stand to be rewarded in the coming months. Clearly, Harvey is rather bullish in regard to the stock market's near-term prospects. We can use his optimism to put together a strategy, and thankfully, Valueline subscriber tools will enable us to do just that. Before we start our formal search, please note that we are currently on our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries and analysis, as well as general interest articles that are written by our research team. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I recommend coming back to our website, especially within the next couple of weeks, as second quarter earnings season commences. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our home pages for our monthly stock selection services, as well as our investor tools. As you know, the point of this presentation is to find a stock to buy right now, so let's go to the screener and get started. This tool can also be found via the Find Ideas tab at the top. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's focus on variables that will generate a list of stocks that are expected to outperform the broader market over the near term. ValueLine's time-tested timeless ranks are a good place to start. The ranks range from 1, highest, to 5, lowest. Although the calculation is purely quantitative and proprietary, I can tell you that it includes a number of variables, including stock price momentum and earnings results. So we simply click on the field and select the ones, since those are expected to be the top performers over the next 6 to 12 months. At any one time, there are always 100 stocks ranked 1 or highest for timeless. If you would like more information in regard to the ValueLine ranking system, I encourage you to consult the user guide on this very topic. It can be accessed via the investment education section of our website. There are also various product-specific guides that will help investors get the most out of their ValueLine subscription. For the next field, I want to utilize a new feature from ValueLine, and it is only available to our subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict the stock's price over an 18-month horizon in terms of a range. In addition to the high and low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely potential profit. The larger the percentage, the greater the possible price appreciation. The 18-month target price range is only available for the 700 stocks covered in the ValueLine Investment Survey, and this purely quantitative measure is displayed on our digital reports. We have also added the 18-month midpoint to our online stock screener so we can use it today. For the midpoint, I'm going to set the low end to 20%. Thus, according to this measure, the most likely scenario calls for the following stocks to increase in price by at least 20% in 18 months. This is a nice potential increase, but since our goal is rather aggressive near-term growth in this largely positive market, I think it is warranted here. And just after those two fields, we're down to just 13 results. As mentioned, the goal is to find near-term candidates, but I also want to make sure that the ValueLine Research Department is bullish over a longer period, particularly from a profit perspective. Reason being, I want to avoid stocks that may just have a good profit advance this year, which may be fueled by a passing fad, accounting benefit, or aggressive share repurchases. Looking longer term will smooth out any of those instances. For this, I'm going to use the projected 3 to 5 year earnings per share growth rate. This is a good time to mention that ValueLine is one of very few research houses that provides financial estimates that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. I'm going to set the low end to 10%, which is a solid expectation. 7 results. All of these may fit nicely in a portfolio focused on market-beating results over the next 12 to 18 months. However, only one can be today's one stock to buy right now, and the victory goes to Cabot Microelectronics, ticker CCMP. Simply put, it appears to have the best balance among the variables we used, including the highest percentage for the 18-month appreciation and second highest for annual EPS growth. Before I dive into CCMP, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the equities digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized stock report. Once you alter the presentation to your liking, you can save the changes by utilizing the sliding horizontal action bar. Next time you come to the report, it will look the way you set it up, and you can apply these changes to other stocks. Cabot Microelectronics is not a household name, so let's start with the business overview module for some basic information. The Illinois headquartered corporation is the leading supplier of high-performance polishing slurries used in the manufacture of semiconductors. The process is called chemical mechanical planarization, or CMP. CMP is a polishing process used by semiconductor manufacturers to flatten many of the multiple insulating materials. Cabot has developed unique slurries for specialized processes, including copper and magnetic heads for hard drives. You will also notice in the business overview module that Cabot generated 80% of its 2018 sales in Asia. This is obviously something to keep in mind since the U.S.-China trade war persists. Admittedly, this may be a reason for some conservative investors to proceed carefully. Moving on, our digital reports possess a great deal of information and analysis, and I can't cover all of the useful modules. However, I do want to discuss a few features that highlight CCMP's favorable prospects and investment merits. First, the valuation module shows the annual historical performance of the company, along with our estimates for 2019 and 2020. A quick scan shows that revenues, profits, cash flows, etc. are all increasing at favorable rates. In fact, they are all expected to take big jumps this year and next, which I will discuss a little bit later on. We also expect that growth will remain strong for many years to come, which is reflected in our 3 to 5 year projections module. As you can see, we project that Cabot stock will trade between $165 and $250 by the 2022-2024 timeframe. Its current price is around 108, which suggests plenty of room to run. I also want to highlight institutional ownership trends. Seeing what the large financial companies are doing can provide clues in regard to bullish or bearish sentiment among large professional investors. As you can see from the gray and blue chart, institutional buying has outnumbered sales in most recent quarters, with a huge increase in the first period of this year. Clearly, from a numbers standpoint, there's a lot to like here. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available using the button on the top right. Here's our most recent report, and let's see what our analyst has to say in the commentary. Many subscribers consider this to be the most important part of our report. Editorial analyst Adam Rosner is constructive on Cabot. Here is an excerpt. Cabot Microelectronics will likely perform well in fiscal 2019. year-end September 30th. Specialty chemical companies' sales rose roughly 86% to $265 million during the fiscal second quarter, meeting our expectations. The sizable improvement largely reflected contributions from the acquisition of KMG Chemicals. It should be noted that on a pro forma basis, business expanded at a moderate pace, reflecting some temporary softness in the technology sector and semiconductor industry in particular. We currently look for Cabot's top line to reach $1.08 billion this year. Meanwhile, the company should benefit from an evolving technology landscape. As consumers adopt more complex computing devices, requiring faster functions and more storage space, demand for Cabot solutions should improve. While there is some temporary weakness, customers will eventually work through elevated inventory levels, and the pricing environment should strengthen. This should start to occur within the next 6 months or so. As for the stock, it is favorably ranked for timeliness and traded at a very reasonable valuation. I want to touch specifically on valuation. As you can see at the top of our report, CCMP was trading at 14.8 times our 12-month share net estimate. That is far below the trailing figure and the median, which is the average of the past 10 years. It is also well under the 18 times we project to the 2022-2024 period. All told, Cabot appears undervalued, and we think that aggressive investors will do well here. In sum, Cabot Microelectronics is today's one stock to buy right now. This marks the end of the formal presentation, and I will now tackle your questions. All right, give me 1 sec to just scroll through. All right, here's a question about that 18-month target price range. Please explain how it works, how you suggest using it to choose stocks, and is there a measure of its historical accuracy? Okay. I'm going to go back to the report and use Cabot as a guide. First off, if you hover over the Explain section, it provides more information. But in short, it uses a combination of historical values for earnings, cash flows, book value, etc., as well as our analyst forward-looking estimates to derive a range. That range is also impacted by the volatility of the particular stock. So stocks that trade more wildly will have a wider range. We then take the midpoint of that range and compare it to the current price, which then gives you that percent to midpoint, which is what I plugged into the screener. So considering no other variable, we think there's a good chance for Cabot to increase 50% within the next 18 months. As far as historical accuracy, we've done ample back testing, and between 2/3 and 3/4 of stocks trade within their 18-month range after 18 months. And this range is updated every week, along with the midpoint and the percentage. So I hope that was helpful. Like I said, consulting the Explain should provide even more information. All right, the semiconductor industry is very cyclical. It's very true. They're up today and have been recently, but after a large decline. It's also true. Where are we in the cycle? Where are the supply chain in the semis? All right, well, I touched on this briefly. Recently, inventory levels were high, which impacted sales at Cabot and other suppliers. It seems like inventories are beginning to work down, which should lead to greater demand over the next 6 months or so. That is our assessment. And we're looking for big jumps in sales at Cabot and several other companies. Cabot gets a further benefit because they made a pretty sizable acquisition recently. Next question. Yeah, this is actually an issue I just discovered recently. The subscriber asks about Fastenal, which is ticker FAST. They were showing a very large gain. That is because they split 2 for 1. That split will be adjusted next week when these ranges update. Any plans to include year-over-year cash flow or EPS percentage changes on the chart? Let's take a look at the PDF. So obviously, I'm assuming in here. Obviously, we show the year-to-year cash flow figures and the EPS figures. We also show the growth rates of the past 10 years, 5 years, and our projections. But placing these figures in the chart, to be honest, that's the first time anyone's ever brought it up. But so no plans to do that. But it's not a bad idea by any stretch of the imagination. All right. Can you please explain the trailing PE and median? Sure. So these numbers right here at the top. The trailing is the last 4 reported quarters of earnings and using our current price. And then the median is the average PE of the past 10 years. So as you can see, using the trailing number and the median, Cabot is trading at a pretty decent discount to those 2 historical figures. And then touching on the 18 that I mentioned, for our projections, and this is a value line estimate that was created in-house, we think this stock will trade more like 18 times earnings over the next 3 to 5 years, which is more in line with the trailing and median. Thus, we think Cabot is currently undervalued. Another way to find out if it's undervalued, and I'll use the chart for this, you can see that the black price dot, this was the price at our last report, and it's trading below our cash flow line, which is one indication that it's potentially undervalued. So if you add all that up, we think the stock is undervalued. Another question about the 18-month target price range. Yes, it is new to value line. We added it about 3 to 4 months ago. Is the fact that CCMP has more debt than cash accounted for in our future projections? Yeah, of course we include interest payments and debt payments into our projections. While they do have more debt than cash, at just 49% of capital, I don't think the debt is onerous or potentially problematic. How will the company be affected by tariffs if a deal is not reached by China? That is certainly a concern, as I mentioned in the report. I would assume it's a reason why the stock hasn't moved as much lately. But Harvey Katz, our economist, is bullish that a deal will be made. So we're not factoring in a long-term trade war. Certainly not, years or anything like that. How often are your reports and data updated for each stock? Sure. So a lot of our data is updated daily, weekly, but we only put out full-page reports such as this on a quarterly basis. So each stock gets a full write-up 4 times a year. When important news and information is released in between our publishing cycle, we put out supplementary reports, which I'll show you. These get written and posted every day by our research team. And we'll take a look at what we posted the last couple of days. So today we wrote supplementary reports on BlackBerry, General Mills, Synapse, and Micron. I believe all 4 reported earnings today. We obviously write several a day. Obviously, during earnings season, we'll write easily 10 or 20 a day. But they are written as news and our analysis changes and posted on our website immediately. So This is an important page to come to on a daily basis to follow what's going on in the market. Do you recommend the 18-month target price range or the 3 to 5 year appreciation potential? Any significant difference or implication? Yes, they're actually completely different. Obviously, the obvious difference is the time frame, 18 months versus 3 to 5 years, but the calculation is also completely different. The 18-month is purely quantitative, using both historical figures and near-term analyst estimates, while the 3 to 5 year target price range is derived solely by the analyst using the 3 to 5 year projections that they create. I recommend using both. Ideally, you'd want a stock that looks good from both variables. Next question, can you assemble a portfolio prioritized based by low PE ratio within an industry? Yeah, you can do that in the screener. So let's do that screen. I'll choose an industry. I'll use a chemical specialty, which is what Cabot is in, and then go to current PE. And then you can just sort by low to high. Obviously, you'd probably want to clear out these big negatives, so maybe you want to start at 5. And that's how you do that. And, of course, you can save this screen. You could also take a bunch of these and create a watch list with them. So all of that's available. Please explain the relative price strength line. Okay, go back to the PDF. That's this bold dotted line. And it basically shows how this stock has fared versus the broader market. So if the dots are increasing left to right, that means it's outperforming. Decreasing left to right, underperforming. So as you can see, there's been a pretty good, decent momentum the last couple of years for this stock, while it kind of flatlined for much of 2012 to through most of 2016. By the way, questions about specific parts of the PDF, all of that is spelled out in multiple guides, which I'll show you. Under Investment Education, Tools, Guides. So there's the Value Line Investment Survey Product Guide and How to Read a Value Line Report. That goes into great specifics about each section of our reports. All right, question about the safety rank. Cabot is a 3 for safety. Safety works the same as timeliness, 1 to 5. For safety, one of the safest companies. So these are the largest, most financially sound stocks that we cover, out to 5, and those are the riskiest. So Cabot's right in the middle. It's an average safety rank. So I wouldn't consider the safety to be a concern. It's not an overly risky stock to invest in. Are the supplementary reports available to print subscribers? Yes. The weekly supplements are included in the back of our printed Value Line Investment Survey. We refer to that as the back of the book. It's in the back of the Ratings and Reports section. But remember, as a print subscriber, you're getting this information a week later. An online subscription, you get it the day of. So there's a clear benefit there. Would you consider the 18-month price target range a fair evaluation of current valuation? I think it's useful. I wouldn't say that any one variable is, a perfect determinant of valuation, but it's a good starting off point in our screener. But as I did, you should add more variables. You should read our reports. I wouldn't use just any one variable to make an investment decision. All right, when you suggest a stock, such as UPS and Cabot, do you post updates, such as a sell? All right, obviously, this webinar, I highlighted Cabot, and I believe I did UPS last month. These webinars are to be meant as one-time in nature. So I won't necessarily comment in future months about previous picks. However, we have several products that do provide that level of service. For instance, Value Line Select, every month, it provides subscribers with our top selection, looking at the risks and reward. So we don't pick overly risky stocks. We're looking at companies that have a really good risk-reward ratio. And after we recommend a stock, we provide constant updates on any changes to the stock, our analysis. We update, buy, hold recommendations. And, of course, when we think the time is right, we recommend a sell. And the sells are provided via email and phone message, so you get them immediately. So for someone that wants a full solution like that, I want to know what to buy, what to sell. Value Line Select, Value Line Select Dividend Income and Growth are two products I would recommend. And for more information on those products or any of our offerings, you can call 1-800-VALUE-LINE to speak to a representative. Does VL review OTC stocks? OTC is over-the-counter or pink sheets. We do track a few. Off the top of my head, it's a lot of the foreign, I believe most of them are based in Japan, some of the car makers and some of the electronics companies. I believe we cover Nissan on the OTC markets and a few others. But we don't actively launch coverage of companies on the OTC. Typically, their trading volume isn't very high, and of course, being on the OTC market, the companies aren't as obligated when it comes to putting out quarterly releases, press releases, financial statements, etc. So we have a few, but we by no means have a large collection. I don't see the expected P of 18. Where is that shown? All right, I'm going to highlight it over here. So here's your average annual P, and there's the 18, which is our projection for the 3 to 5 year time frame. It's on the PDF in the rightest column. There's a couple of questions about people who entered the call late. This presentation will be posted on our website and our YouTube channel within the next 48 hours. So I recommend tuning in then. All right, that appears to be all of the questions. I really appreciate everyone for attending and everyone who asked a question. They were really solid questions. Much appreciated. Well, that ends today's presentation. Thank you very much, and have a great day.